Let's put up a one-week chart for the S&P 500. Investors breathed a sigh of relief yesterday after US President Donald Trump backed down, or at least softened, his threats to impose tariffs on European countries who don't support a US takeover of Greenland. Our guest has some ideas for your portfolio. Joining us now, Garnet Anderson, VP and Head of Portfolio Management at Tacita Capital. Great to see you.
Good morning.
So it does look as though the market was relieved that Trump doesn't plan an invasion, whether that was ever on the cards.
Whether it was ever in the cards and what happened the last 24 hours, into your earlier point, one side said there's a deal, and the other side said there's not a deal. Denmark's got something to say about it. The cages are still being rattled. You can see why gold, yes, is off a little bit this morning, but it's not as if it's dropped $50 or what have you, sort of thing. So geopolitical risk is still front and center. I mean, lost in the background, you still have Ukraine, Russia going on. You still have friction with China. You still have the situation in Israel, Gaza. So it's still a world that is fraught with risk, and I think that's coming through in the price of gold, and certainly in gold producers.
Yeah, I mean, Trump has got all these pots on the boil. Confrontation with Iran. He scooped up the leader of Venezuela, but seems to be happy with leaving the regime in place there.
Right. We'll be interested in the final reconciliation of the oil revenue versus the oil revenue that went back to Venezuela and what was scooped, and what that does long-term to energy prices. Certainly has a high activity level, but a lot of the activity level, again, is stoking concern around the world, which is good for precious metals.
Well, what has a high activity level?
Well, if you think all the things, to your point,
yeah.
Trump is right, left, and center in terms of going at Venezuela, talking about Mexico, talking about Canada, talking about Greenland, Iran, his peace group. I mean, every day it's a wake up and it's like, okay, who's the target today and what's the methodology? And so that keeps people on their toes. And when people get anxious about that, they think, okay, where can I go to for safety? And some will certainly go over into bonds, but then even with those that start to worry a little bit about treasuries, I think that's overdone. U.S. treasuries are still U.S. treasuries.
Yeah.
But there will be protest selling to a degree. We saw that out of the Danish pension group sort of thing. But I think that will be fairly minimal, all things considered. And so again, you kind of go, okay, well, what are quality equities that can withstand some challenges? Which ones have moats, so protections around? Which ones have some yield? Usually we're not huge yield-oriented investors because a lot of the capital we manage is taxable, and we prefer to have capital gains realized years down the line. But when you get to unrestful times, having a little bit of income coming into the portfolio, which is more stable than share prices, that can help, calm down a portfolio as well.
Maybe we could have a look at the yield on the US 10-year bond, because of course you'd expect that to really spike if there was a wholesale retreat from US treasuries.
Well, yes, you certainly would expect it to spike on that basis. And then if there was going to be another conflict, they get expensive, that drives up inflation more. Does that then move up? The other thing that will affect that, or could potentially affect that, we still have the change in the Fed coming down the pipeline. And, it's one thing to do with short-term rates, and that's where so much of the focus goes. But what they're doing with their balance sheet is key, because that's almost more what affects or can adjust what's happening at the longer-term rates, which affects business borrowing, which affects mortgages stateside and home ownership and so on and so forth. So it is that risk that permeates through could be short-term, which will drop rates, but there's true risk, to your point, the longer-term rates that could spike and then self-inflict pain on the U.S. consumer.
We got some jobs data out of the States today. What do they tell you?
Pretty milquetoast, all things considered. Jobless claims were about 200,000, a little bit below expectations, a little bit higher than the prior week. When you take a look at on a rolling 4-week basis, again, fairly docile. It's settled back in. We're kind of in that no hire, no fire kind of motif out there. On the no hire, you've got, again, the geopolitical risk, the tariff concerns. You've got AI. Do you go and hire 5 people, or do you make an investment and try to get efficiencies that way? And on the other side, companies still remember, that skilled labor can be difficult to get by, come by. Don't get rid of it too quickly coming out of COVID. And so there still is not massive fire. So you take a look at the challenger jobs, for example. December is usually light. tend not to announce mass layoffs in December.
No.
But even coming into October and November, you could see that retreating. So it's just everybody's kind of staying pretty close. And then you've got the unemployment rate stays relatively stable stateside because you also have people that are leaving the job market.
You have a couple of stock ideas for us. Brookfield Infrastructure.
Yes, it comes back to the comment around yield. Now, we've had Brookfield Infrastructure in our real asset portfolio from the get-go. We've had it at an overweight position. We always looked at it as like an all-in-one infrastructure play. And that's from transmission, electrical, from gas pipelines to cell phone towers to now data centers, the backstop. So if you want a little taste of the AI play, but you don't want to get into the hyperscalers, these are the providers behind. And what you get there, you get very dynamic management. They recycle their capital. They are dating. They're not marrying their underlying investments. And they're not going out and raise a bunch of capital, so they're not diluting out the stock. They've managed to increase their dividend, call it 8-9% per year sort of thing. So that's pretty strong. This year compared to last year for the third quarter, they turned a negative or a loss into a gain. So very much positive. They've got their earnings coming out next week. And if they're able to put up another surprise, I think there could be a little bit of energy behind it. Because purpose, all things considered, it hasn't knocked the socks off of its stock price. It's not one of these stocks that has just rocketed higher. When you take a look at valuation levels, it's not sitting up at the 95th percentile of its historical valuation metrics. So it could have some room, but regardless, it is a long-term hold in our portfolio. We recognize that there can be downside. Just like many infrastructure companies, they come with debt. And when people get anxious about debt or the economy, you do see some sell-offs there. So it's nothing that you would go absolutely crazy about, but a good solid position in Canadian portfolios.
Garnet, thank you very much indeed. Garnet Anderson, Vice President and Head of Portfolio Manager at Tacita Capital.